Your market news now. Stocks fell in Asia, dragged by tech shares as Fitch ratings downgrade after the U.S. sovereign's credit rating also weighed on risk sentiment. Some investors booked profits in the absence of concrete and forceful measures by Beijing to shore up its faltering economy. Meanwhile, attention is still firmly on monetary policy, with uncertainty around how much the Bank of England will raise rates tomorrow. Corporate earnings and economic data will also remain in focus, with the US due to publish fresh jobs markets data this week. To give us more perspective on the markets, we are joined by Chantal Marx, who's from F&B Wealth and Investment. Chantal, thank you so much for your time. You look at what's happening with the Treasury yields on the back of the Fitch downgrade. Talk to me about the significance of this thing and I suppose what it means for markets, especially risk assets.
I don't think it would have been as significant if markets weren't skittish already around the growth narrative and interest rates and the path forward. But it does come at a time where markets are looking for reasons to come under pressure. We saw yesterday as well, global markets coming under pressure because of some misses on the manufacturing PMI numbers from a variety of countries. So this just kind of follows on to that. Fitch actually is downgrading the US 10 years, more than 10 years after S&P downgraded the US. They said that the fiscal deficit is ballooning, which is something that we know. And they've also cited these debt ceiling negotiations that tend to go to the 99th or to the 99th hour every single time as one of the reasons why they decided to downgrade the credit of the largest economy in the world. So what we've seen was actually quite interesting. We saw the dollar actually strengthen on the news, and we saw treasuries increase or treasury prices increase, yields coming down, which told us that investors are actually still looking towards the US as a safe haven when they freaked out about the US. So in that way, I think that it is not as significant as some may want us to believe.
So locally, we had the JSE publish its interim results, and I'm looking at the share price now, up about 1.9%. Were there any highlights for you when you look at those figures?
It was just an all-round solid print, and they managed to improve revenue across most of their businesses, probably with the exception of equities trading where volumes came under pressure, but we were aware of this already. And what was also interesting was because they have this really big cash pile, and interest rates increased, their interest income was much larger than it was last year, and that really supported the bottom line. I think this was just a super clean set of numbers, margins holding up quite well, and a print that I think investors will be quite comfortable with.
When you look back at the month of July, how would you characterize it, both from a local and global perspective in terms of performance?
It was a very strong month for risk assets. I think in July we started getting clues that the global economy is holding up, particularly the US, and interest rate hikes may be coming to an end soon because inflation started decelerating, or at least the inflation data that we got from June showed that there was a deflationary pressure building globally, not only in the United States. So the combination of those two things resulted in investors becoming quite optimistic that a recession in the US and Europe could be avoided this year. And that really buoyed global markets, including the JSE. The JSE also benefited from the idea that China will offer more stimulus to push its economy back onto the growth path that it wants it to be on. And that was really good for resources stocks. The JSE looked even better in US dollar terms because we also saw the rand strengthening by quite a bit in July. Unfortunately, a lot of those gains being reversed in the first 2 days of the new month.
So we are going to be seeing a lot of the local banks publish their results, the likes of Absa, Nedbank, Standard Bank, you name it. What are you going to be looking for when it comes to the bank's earnings?
I think most investors know that net interest income is going to be very strong because interest rates are high. I think at the moment, our focus will be on non-interest revenue, so transactional revenue and other streams of revenue, which will really give us insight into how the consumer in South Africa is faring. And then more importantly, we'll be focusing on credit loss ratios. Has the credit environment deteriorated or has it held up quite well given what macroeconomic fundamentals are doing currently? I think if we see a meaningful deterioration in credit ratios and signs that the South African consumer may be under a lot of pressure and that there could be defaults coming through on the credit side for banks, then that would be very negatively perceived. On the flip side, if it stays more or less in line with what these banks have been guiding for, I think the market will be quite comfortable with those numbers.
And as we wrap up in just a few seconds, what do you make of the read-through we've gotten so far when it comes to US earnings? Are you satisfied?
It's been such an interesting week because at the end of last week, earnings were still positive on an aggregate basis, and revenue was still well beyond what was expected from this earnings season. And then the last 2 days happened, and earnings season, along with everything else that's happened over the last 2 days, just seems to have run out of steam. So while we still have revenue and earnings numbers generally doing better than expected, we now have earnings on an aggregate basis being negative. As I mentioned, it's still better than expected, but now actually turning into negative territory. So if you ask me Friday, brilliant. If you ask me today, I'm not so sure.
All right, Chantal, thank you so much for your time. That is Chantal Marks from F&B Wealth and Investment. We're going to take a quick break. When we come back, we'll have more news, so stay tuned.